Thank you for being with us on our Q3 and 9 months of financial year 2023 earnings conference call of Jubilant Ingrevia Limited. I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release and results presentation that has been shared on our website. On the call today, we have Mr. Shyam Bhartia, Chairman, Mr. Rajesh Srivastava, CEO and Managing Director, Mr. Prakash Chandra Bisht, CFO, Jubilant Ingrevia Limited, and Mr. Arvind Chokhani, Group CFO, Jubilant Bhartia Group. I now invite Mr. Shyam Bhartia to share his comments.
Thank you, Pavleen. A very good evening to everyone. Thank you for joining us on Q3 FY23 earnings conference call of Jubilant Ingrevia Limited. We are pleased to announce stable performance during the quarter under review amidst the continuing headwinds of higher energy costs and challenging global market situation. We are also glad to share that the board has recommended interim dividend of 250%, that is 2.50 per equity share of the face value of rupees 1 each for the FY23. This shall result in cash outflow of rupees 39.8 crores. We are pleased to inform that our specialty chemical business revenue grew by 34% year-on-year, and absolute EBITDA grew 15% year-on-year, driven by higher volumes and improved price realization. In nutrition and health solution business, the demand of niacinamide, vitamin B3, continue to be subdued, impacting our price realization. Though we have improved our volumes sequentially, the flu situation in EU and US regions is still continuing. Though the situation is improving in EU region, the demand-related challenges of vitamin B3 are short-term, and we continue to remain focused towards improving our presence in food and cosmetic segment. In chemical intermediate business, the revenue on year-on-year is impacted due to lower prices of feedstock, acetic acid, leading to lower sales prices of acetic anhydride and ethyl acetate. However, we continue to improve our volumes and market share of acetic anhydride globally. The company has firm plans to significantly reduce overall energy costs in phased manner through various initiatives such as sourcing power from grid and renewable resources, optimizing coal consumption through efficiency improvement in consumption as well as in generation. We continue to focus our growth plans through new products and platforms, and we are committed to deliver robust growth in the future. With this, I now hand over to Rajesh to discuss about the business in detail. Before that, on behalf of the entire team in Jubilant, we wish all of you a very joyful and a prosperous new year. Thank you.
Thank you, Mr. Bhartia. A very good evening to all of you. At the outset, let me welcome you all for joining us today for Q3 FY23 investor call of Jubilant Ingrevia Limited. I sincerely hope that you and your loved ones are keeping very well. Let me now take you through the financial and operational performance of Jubilant Ingrevia Limited for the third quarter of this financial year. Revenue during the quarter was rupees 1,158 crore rupees. Overall, revenue degrew by 10% year-on-year basis, mainly on account of lower sales performance by nutrition and health solution business, driven by lower demand due to swine and bird flu in EU and US region, and chemical intermediate business driven by lower price of acetic acid, leading to lower realization. EBITDA is at rupees 158 crore, though specialty chemical EBITDA improved. However, higher energy costs due to non-availability of contracted coal lower volume offtake of vitamin B3 has impacted EBITDA adversely, while specialty chemical business volumes have grown significantly along with the improved pricing. As mentioned by Mr. Bhatia, to minimize the risk of our energy costs increase due to increase in coal price in future, we have prepared a detailed plans to work towards various initiatives to source power from grid at Gajarola and from renewable sources at all our sites. We have also prepared detailed plan and initiatives including digital interventions to optimize coal consumption through efficiency improvement in consumption as well as in generation. These plans will start giving benefits in phased manner. Now let me take you through the updates on all our three business segments. Specialty chemicals business. During the quarter, revenue of the specialty chemical business was at rupees 468 crore, witnessed a year-on-year growth of 34%, and EBITDA was at rupees 87 crore, witnessing an absolute year-on-year growth of 15%. The specialty chemical segment absolute EBITDA increased by 15% mainly due to higher volumes and better price realization. EBITDA margin remained lower mainly due to higher cost of coal compared to same period previous year. Our business team has been successful to pass on most of the raw material costs and also partially increased energy cost. Although during the quarter we witnessed softening of imported coal prices. The specialty chemicals revenue grew mainly on ground of higher volumes across major product segments and improvement in price realization. We continue to observe positive traction of demand for our other specialty chemicals from both domestic as well as international customers. We continue to witness higher demand of our pyridine and its derivatives from Chinese customers as well. Our CDMO pipeline is healthy and progressing positively. Our new GMP and non-GMP facilities projects are slightly delayed by couple of months and are expected to be commissioned in next 2 months time frame. Nutrition and health solution business. Nutrition business revenue was at rupees 132 crore, which witnessed degrowth by 39% on account of continued lower demand scenario owing to excess inventory across the value chain, primarily led by continuation of avian and swine flu in Europe and US market. Demand continued to be remain impacted also due to geopolitical situation in Europe and severe COVID restrictions in China. EBITDA and EBITDA margin was significantly lower, mainly on account of lower sales volume and price realization of niacinamide. We continue to increase our presence of niacinamide vitamin B3 in food and cosmetic end use segment. Our domestic business of choline chloride, that is vitamin B4, as well as its specialty premixes have grown in volume and value both on year-on-year basis as well as quarter-on-quarter basis. We have also seen positive traction of demand from Southeast Asia for our choline chloride vitamin B4 and its specialty premixes. We believe these challenges to be short-term and remain positive on the prospects of niacinamide vitamin B3 business in the medium and long term, and we aspire to retain our leadership position in global market. Chemical intermediate business. Revenue from chemical intermediate segment was at rupees 559 crore, down by 23% on year-on-year basis, mainly driven by lower price of feedstock, that is acetic acid, leading to lower realization of finished products, that is acetic anhydride and ethyl acetate. EBITDA in chemical intermediate segment stood at rupees 71 crore due to normalization of domestic market condition in Q3FY23, same quarter last year. We continue to grow our volume to increase our market share and maintain leadership position in domestic market as well as in international market, mainly in Europe and Southeast Asia. Global demand of acetic anhydride continues to grow in several use segments, and there is no new capacity coming up globally. While we continue to leverage our capacity from existing as well as newly built plant, Further, our upcoming acetic anhydride plant at Bharuch is nearing completion and is expected to be ready during Q4 FY23. For ethyl acetate, we remain focused towards our key strategic customers. Outlook and growth CapEx plans. Our specialty chemical segment would continue to grow. Overall, our FY23 full year performance is expected to remain in line with our last 3 quarters. We are fully committed towards our growth aspiration, and we are excited to realize the emerging opportunities through our ongoing growth CapEx plan, which we have now improved from earlier 2,050 crore to now 2,275 crore during FY22 to FY25 period. We continue our efforts towards improving our revenue mix of specialty and nutrition segments to 65% by FY27 from 44% in FY22, and we believe this to be a key driver for our overall EBITDA and margin improvements. With this, now I hand over to Prakash to discuss the financials.
Thank you, Rajesh. A very good evening to everyone, and thank you for joining us on Q3 FY23 earnings conference call. I would now highlight the company's financial performance during the quarter and 9 months ended 31st December 2022. Revenue from operations during Q3 FY23 was at 1,158 crores as compared with 1,286 crores in Q3 last year, witnessing a degrowth of 10% on YOY basis. Similarly, revenue from operations during 9 months FY23 was at 3,628 crores as compared with 3,654 crores during the same period last year, witnessing a marginal degrowth of 1% on year-on-year basis. The EBITDA during the quarter was at 158 crores as compared with 222 crores in Q3 FY22, witnessing a decline of 29% on year-on-year basis. The margins stood at 13.7% in Q3 FY23 as against 17.3% in Q3 FY22. Though our specialty chemical EBITDA improved absolute, the overall impact is mainly due to significantly lower profitability in nutrition business and non-availability of contractual coal, leading to higher energy cost. Similarly, EBITDA for 9 months FY23 was at 469 crores as compared with 712 crores during 9 months FY22. Margins were at 12.9% during 9 months FY23 as compared with 19.5% for the same period last year. The EBITDA is impacted due to lower volume offtake of vitamin B3, chemical intermediate segment normalization, and high input cost impact in the specialty chemical business due to non-availability of contracted coal. Depreciation and amortization expenses during the quarter was at 30 crores. Finance cost during the quarter was at 6.7 crores versus 4.9 crores in Q3 FY22. Interest cost was higher mainly on account of increase in the interest rates and higher utilization of working capital facilities. Net debt was at 352 crores at the end of Q3 FY23, and blended interest rate as on 31st December 22 was 7.03%. The tax expense for Q3 FY23 was at 30 crore. Tax expenses for the quarter is lower on account of certain one-time true-ups. The company remains under the old tax regime during FY23, and the ETR is expected to remain around 31% for the full year. PAT during the quarter was at 92 crores as against 129 crore in Q3 FY22, witnessing a decline of 29% on YOY basis due to lower EBITDA. Similarly, PAT for 9 months FY23 was at 256 crores against 408 crores PAT in 9 months FY22. Net debt to EBITDA ratio was at 0.57 times on the basis of trailing 12 months EBITDA. The net working capital percentage and number of days of working capital for Q3 FY23 on the basis of trailing 12 months turnover was at 19.4% and 71 days respectively. Increase in net working capital is driven by strategic decision of inventory building of certain products and temporary lower creditors due to procurement of domestic ethanol. The capital expenditure during the quarter was around 148 crores. With this, I would like to conclude our opening remarks. We will now be happy to address any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Tarang Agrawal from Old Bridge Capital. Please go ahead.
Hello, sir. Good evening. Thank you for your time. 3 questions from me. One, if you could give us the volume growth across each of your segments for this quarter. Second, in the press release, I noticed that, there's a comment around specialty chemicals garnering a lot of traction in the agrochemical segment. So if you could give us some sense on what proportion of specialty chemicals business was from, agro customers for 9-month FY23, and what was this number for 9-month FY22? And the last question is on power and fuel. You alluded to costs softening. So how should we look at it going forward for Q4 and probably subsequently from Q1 next year onwards? Thank you.
So Tarang, on your first question of volume growth, as you can see that the volume growth has come clearly from specialty chemical business, and in nutrition business we have informed you that there is a degrowth in volume both year on year as well as quarter on quarter. In chemical intermediate, though you see the volume degrowth overall basis, but as we informed on acetic anhydride, we have grown in volume. So actually, other than the nutrition business, in overall business, the volume consistently is growing in specialty chemical as well as acetic anhydride. And since nutrition business niacinamide situation has not improved, we are not in a position to grow volume. And the question number 2 on agrochemical business portion of our specialty chemical, if you see the agrochemical is close to 40% of our specialty chemical business. This is almost same in quarter on quarter as well as year on year basis. On power and fuel, the vis-a-vis Q2, we have seen little bit softening of coal prices of import, and therefore there is a slight benefit, not much, very, very little. But in Q4, we are expecting a little more benefit because of 2 reasons. One is the coal prices are also coming down in import, as well as we have now got some clearance of our contracted coal with road transportation. So there will be some benefit of a cost, but of course it will not be the full benefit of our cost of FSA. Hope I have answered all your 3 questions.
So just one question for volume growth. I was actually looking at numbers specifically for each of the segments.
Yeah, I explained to you that in specialty chemical we have grown both quarter on quarter as well as year on year in volume. Nutrition we have not grown, particularly on niacinamide, though we have grown in our vitamin B4 choline chloride, which I have also stated in my speech. On acetic anhydride we have grown in volume both quarter on quarter as well as year on year. But ethyl acetate is not a focus product. We sell only when we get a sufficient margin for us. And that's where you see the reduction in volume. We have not sold much ethyl acetate.
Okay. Thank you, sir.
Thank you. The next question is from the line of Nitesh Dhoot from Prabhudas Lilladher. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. So my first question is on the specialty chemicals. So we see that there's a sequential revenue decline, in Q3. So what is that on account of? Is there a sequential volume decline or a price decline? What exactly it is?
So the revenue decline on sequential basis is purely on product mix. As you know, we have almost 60 to 70 products in our specialty chemical segment. So sometime in some quarter, you have a product mix which gives you a little bit of lower revenue, but that doesn't mean that our volume has not grown. So volume, as I said, volume has grown, but there is a product mix change which changes the price realization, but of course does not changes the EBITDA and volume.
Sure. And on the domestic sales for specialty chemicals, that has declined from 197 crores to around 164 crores. So are we facing any pressure in the domestic market? And what would be the status of our diketene derivatives plant there? What will be the utilization currently?
Yeah. So you are very right. In current situation, as you know, we are facing a very low demand in diketene derivatives, which now we can see a positive traction happening even in diketene derivative this quarter. But yes, you are right. Last quarter we have seen diketene demand having lower, but that's an opportunity for us to grow our revenue in domestic market through diketene, which we can see now, as well as with other products.
Sure. All right. And sir, on the EBITDA, so basically if you see that there's a sequential increase in the specialty chemicals EBITDA, and the margins have come up to 18.6%. And this is despite the coal availability not easing. So how did we manage to to increase the margins in the specialty chemical segment? If you can give some color.
Yeah. So I expect you that the increase in EBITDA has come both. One is from volume. Secondly, we also said in the last call that though we are not in a position to do anything on coal cost, but we are definitely working with customer to pass on the cost to our customers, and somewhat we are successful to partially pass on that cost increase, and therefore you see the EBITDA margin improving. And going forward, both we will see the softening of coal prices as well as the realization which we have now taken the price increase to customer, giving us better result in future.
Sure. So just one clarification here. So if I remember our previous discussion, basically, imported coal price movements are generally a pass-through. It is the difference between the FSA coal price and the imported coal price, which is in a way a benefit for us. And if the FSA's availability is not easing, so does it really, have any benefit for us? I mean, the imported coal price is going down.
Yeah. So as we have been saying that our contracted coal issue is only at our one site, which is Gajraula. Rest, all other sites are based on imported coal. Now in Gajraula also, we partially have imported coal. So therefore, the impact in Gajraula products is there. But I also mentioned to you that we are in a position to partially pass on the cost increase even in Gajraula for our contracted coal. And therefore, you see the EBITDA improvement in specialty chemicals.
Sure. Sir, next is on the energy efficiency projects that you have highlighted in the presentation, and the debottlenecking projects. So, what kind of margin benefit, that we can expect, from this, and what will be the quantum of investments going into these energy efficiency projects?
So, honestly speaking, there is not large investment in these projects. These are mostly business excellence projects. So these projects are actually in the four segments. One, wherever our cost of generation of power today is higher with our own generation versus grid, like in Gajraula, we are opening up to the grid. That will give us saving. Number two, we are going to improve efficiency of operation through the digital intervention. So we are taking a very major program of digitalization in all our energy production. That will give us the benefit. And third, we are also working on how to minimize the consumption side in the product. So combining all these excellence initiatives, we are gradually phase-wise going to get benefit of these programs. Apart from going green in solar, which is the fourth initiative which we are talking about in energy saving. So there are clear-cut 4 initiatives in business we have planned, which is going to be in phased manner. Some of the initiatives will start giving results in couple of quarters, and some initiatives might take longer time because you need to make investments and take the benefits later.
Sure, but can this be quantified in terms of 100 to 200 basis points of margin improvement in the chemicals business, or maybe if you can just highlight that?
Yeah, once the entire program is implemented, then I can tell you this is going to be a significant benefit. This will be definitely significant benefit. Unfortunately, I am not in a position to give any number because we are still working with our partners to put down these numbers on a hard basis. Maybe after a couple of quarters, I will be in a position to give you a certainty of numbers or some indication of numbers. But I can only assure you this is going to be a significant improvement in our overall profitability if we are in a position to implement all these initiatives.
Right. Maybe, sorry if I'm repeating, but on the FSA, so is there, we had earlier expected that, from January onwards, the availability will ease. But it doesn't seem that, much of benefit has started coming in. So, what is our view there? Do we see this coming in, a quarter's time, or what exactly, are you envisaging over there?
Yeah. So based on our discussion with the various agencies, we don't see this FSA to be 100% clear to us in next couple of quarters. But having said so, I am pleased to inform you that from Q4, and I can say from this month onwards, we are now allowed to take our contractual coal at the contractual price, but from road transportation. So we are going to get benefit in our cost, but not the 100% benefit. So this quarter onwards, you will see the benefit in our cost in our coal in Gajraula, because now we are allowed to take road transportation contractual coal. But as per our information from various sources, we don't see the full FSA benefit coming to us either in this quarter or in next quarter, unless there is a very, very huge production of coal and availability of rakes. Actually, the major issue is happening, the availability of rail transportation. In fact, the coal is available. Government is also working very, very aggressively to make the rail available for the industry. If they are successful to do it in next 2-3 months, probably we'll get the benefit. But at least I don't see in next 3 to 4 months that happening. But I think major relief has happened because we have got this clearance to get our contractual coal with road transport. So that's the benefit we will start getting from this quarter onwards.
Sure. So in that case, would it be fair to assume, 18.5%, 19% kind of margins as sustainable margins for specialty chemicals? Would that be a fair understanding till the time the efficiency, the energy efficiency, projects don't come up fully? So would that be a fair understanding?
Nitesh, this is the discussion we had also 3 months before when you said that margins will be, but you see margins are improving. The reason is that we are not stopping our realization. We are trying to recover the cost increase from our customer. From the products, we can recover our cost. So I don't make any commitment on the margins that it will not improve, because it will all depend that if we can realize better pricing in our product, we can meet all the volumes projections, probably we should be improving. Why not?
Great.
Thank you. Sorry to interrupt you, Ms. Nitesh Dhoot. If you have any follow-up questions, we request you to please come back in the queue. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Hi, sir. Good evening, and thanks for the opportunity. Yes, I'm audible, sir.
Yes, you are audible.
Okay. Sir, first question is on our nutrition and health solution business. So, we understand that there is a high inventory scenario, but I think that the impact on revenue is slightly less than what impact we have seen on the profitability or segment EBIT, which has come down to drastically to just 5 crore, while nutrition health solution has seen some revenue improvement on Q-on-Q basis. So is there any inventory losses we have booked, or it's just cleaning up the inventory at a lower prices which is impacting the profitability, or the overall realization itself has come down? So what is the reason for the such a sharp fall on EBITDA or EBIT on nutrition and solution?
So Rohan, last quarter when we started, the pricing was not as bad as what we saw at the end of the last quarter. So therefore, the margins of last quarter are better. Having said so, your observation on revenue increase is correct. So this quarter, we have sold a little higher volume of niacinamide. The reason that we are getting our customers' requirement wherever we are selling on a positive contribution, we want to take the orders. And some improvements in volume in this quarter has happened. And in the current quarter, which is quarter 4, we still estimate that our situation of volume should be better. As well as in this quarter, we are estimating that price should also improve. Because last quarter, there were multiple problems. Number one, as we said, the swine flu and avian flu in US and Europe. And the major impact was also from China. Consumption was much, much lower because China had big restrictions because of COVID. But if you see the China getting opened up last month, we can see the China demand improving, and which is actually making the whole nutraceutical segment little bit positive, even though the flu situation has not improved. So vis-a-vis Q2, of course, it was lower Q3, but we see Q4 becoming little better than Q2. That's what we estimate.
So, sir, unlike specialty chemicals, where any cost increase we are trying to pass it on, nutrition and health solution business is seeing a severe margin pressure, and the prices are still under significantly lower than what it used to be. Just wanted to understand that how this nutrition health solution business pricing works to the end customer, and how you decide on the margins front. It is just completely driven by the demand supply scenario, or you see that there is some cost plus element is also there.
So, Rohan, good question. So, our nutrition segment, if you see, we have 70% of our revenue of nutrition segment coming from feed industry, animal feed industry, and 30% comes from food and cosmetics and others. Now, this 70% animal feed is impacting our volume and revenue because of demand. So, answer to your question is, it is demand and supply situation. But our efforts for future is that can we reduce this dependency on animal feed of our nutrition business to more food and cosmetics so that we can balance out, so that this kind of impact does not come in our revenue and profitability. So you are right that currently it's demand and supply situation which impacts our volume as well as profitability.
And so thirdly on...
Sorry to interrupt, sir. We would request you to please come back in the queue. The next question. Before we take the next question, I would like to make an announcement. Participants, please limit your questions to 2 per participant. Should you have any follow-up questions, you may join the queue back. The next question is from the line of Siddharth Kadekar from Equirus Securities. Please go ahead.
Hi, sir. So just wanted some color in terms of we had announced a long-term contract for a CDM of 270 crores over 3 years. So what is the status of that project?
So we are servicing that contract, and actually speaking, the volumes of that contract will start increasing from this quarter end onwards. And as you see that the new capacity of GMP which we are building up, we are making it ready with that servicing that contract. And in fact, the overall CDMO traction, not only with that contract, but also with other products are showing a positive results, and we are expected to see a better performance of our GMP facility, which we are building up, which will be ready in next couple of months' time. So that is on track, and we are servicing it on time.
So basically, FY24, we can see the entire 90 crores coming in from that project?
No, yeah. So you are saying that FY23 annual revenue, yes, it should come full because that's the capacity we are building up. Correct?
Oh, okay, got it. So, and secondly, now in terms of nicotine, what kind of capacity utilization can we expect in FY24 and 25?
So FY24 with our current estimates, I think we are planning to utilize to 70 to 75% of capacity.
Okay. And the non-GMP plants also will be at similar levels in FY24? They will take time to ramp up?
Yeah, as of now it looks like that, but you never know. If demand improves, we can even utilize better.
Okay, so got it. So the last question, in the nutrition segment, have we changed any capex? Because now we are looking at some cosmetic grade vitamin D3 as well, which was not there before. Is this something new that we have announced?
Yeah, very right. And that's what I just mentioned to Rohan also, that in nutrition segment, now our endeavor is to improve our presence in non-animal feed segment more. And therefore, we are bringing up more capacity of cosmetic grade.
In the capex plan also, you would see that one debottlenecking for pyridine that will also add to the capacity.
Okay. Coming to that. Okay, sir. At current, even after the 9 months volume growth, which I believe could be probably 20%, of course, I'm not sure, the pyridine capacity 70-75% utilized.
Yeah, correct. And remember, this overall volume growth is from existing products as well as from new products. So we do, other than these announced capex, which you see in our presentation, we have continuously debottlenecking capex and capital investment, which happens regularly, which normally we don't announce. Because that, as you know, we keep doing it based on the customer demand of our existing products.
Sure. There are two quick questions. Is your two CGMP plants, both are one the CGMP, non-CGMP both are coming online, I believe, in the next quarter. Just wanted to get some better understanding on terms of the visibility of ramp up. Probably one often sees in the industry that they have contracts in hand based on which the ramp up visibility is there. So just wanted to get your sense also in terms of the visibility for the ramp up of these capacities. Do you have contracts, or are these established products, or are the products already developed so that you only have to market it once the capacities are ready? Just trying to understand on the get better visibility on the ramp up, sir.
So I have already stated in the last question that the CGMP plant which we are building up is based on our new demand and new orders which we have already got it. And there was actually additional traction, and therefore we took little bit more expansion of the existing facility, and therefore there is a delay of about a month or two. And hence, the utilization of CGMP plant is going to be in a very good situation. As we stated earlier, the first year itself, you will see a utilization of more than 70% of CGMP plant, and the same is true for non-CGMP plant, because CGMP is utilized for the more value-added product, and non-CGMP is utilized for the early derivatives and intermediates. So both plants are going to be utilized as per plan. We have a strong order situation. So as soon as the plant will come next year, we will have a good traction of utilization, as we have been saying, close to 70 to 75%. And next 2 to 3 years, that's what we said. In next 2 to 3 years, we will reach close to 85-90%.
Sorry to interrupt you, sir. I would request you to please come back in the queue. We'll move to the next question from the line of Rahul Pira from Abacus Asset Manager. Please go ahead.
Hi, sir. Sir, a very interesting comment that you've given in the presentation that FY23 year will largely be similar to the past 3 quarters. So given the improvement in coal cost plus the ramp up in the CDMO, shouldn't it be a very sharp improvement sequentially? I understand you mentioned that it's going to be very marginal in terms of coal cost improvement, but I still believe there could be a much better opportunity, right?
As I said, in coal cost, it is a marginal improvement, and as also I have said that nutraceutical business we don't see much improvement, and specialty chemicals, of course, there is an improvement. So when I say it will be in line with last 3 quarters, I don't know what you understand, but I'm not saying that we will be significantly higher or better than what we have been doing in last 3 quarters.
Okay, fair point. And so the capex, incremental capex that we given from 2,000 crores to 2,275 now in the presentation, this is largely going towards the debottlenecking only?
No, so it's about 3 things. One is debottlenecking. Secondly, I just explained that we are adding new capital plan for nutraceutical vitamin B4 for food business. You can see about 100 crore increase in nutraceutical segment and debottlenecking. And third, we are also having the R&D expansion because of our good CDMO traction. So we are having some R&D investment plan which we have highlighted in this increased investment plan. Of course, debottlenecking is part of that.
Sure. Fair point, sir. Got it. Thank you so much.
Thank you. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. Sir, just wanted to ask 2 questions. About diketene plant, have we started commercial sales and has the production quality been accepted by general market? That is first. And if it is, then what is the 100% utilization revenue potential for this plant at current price? That is first question. Also, second question is that so if the rake availability improves and government say allows railway rakes, then how much of the saving could be done in the energy costs? Thanks a lot.
So 3 questions. I think number 1 question was on your nutraceutical, I believe. Can you just repeat your first question?
Yes.
First question is on the quality of diketene, then capacity utilization and
quality of diketene.
Revenue potential.
We have told you that we have already started selling the diketene, but unfortunately, because of the lower demand, we were not in a position to utilize the plant. But now we see the demand is improving, and therefore we are very confident that next year we should be in a position to utilize, as I said, about 75 to 80% or 70-75% of the capacity. Now, second question on your FSA coal. Now, if after the road transportation, which we have just got cleared, if we convert that to total FSA coal on a quarter basis, I think we should be in a position to add about, Prakash, if I am right, about 15 to 20 crore of EBITDA further, if that happens.
Right. Yeah.
Right. So, and diketene plant revenue potential is how much?
So we have a capacity of 8,000 ton. It's difficult to give a price commitment. So there are 3 products, and each of these products are ranging from a price of 150 to 200 rupees, or sometime it is more. So based on that 8,000 ton capacity, you can calculate the revenue. But it also depends that which product you are maximizing to maximize your revenue and profitability.
Right. So $150 per ton, na?
No. Rupees. This is rupees. But plus, as we have been saying that the phase 2 of diketene is much awaited because this capacity of ours is not for 100% sale. This is for a backward, this is for forward integration of building blocks. So this we have built up to make value-added products, which I have been talking all the time. Phase 2 investments will come very soon, and therefore the realization from the existing capacities as well as new capacity is going to be higher, and that's our endeavor, not to sell this 8,000 ton only as a commodity or bulk volume. So our endeavor is, this was the beginning to launch as a building block and then add the value-added product, which we will bring up very soon, the phase 2.
Right. Perfect, sir. Thanks.
Thank you. The next question is from the line of Harsha from Dimensional Securities. Please go ahead.
Hi, good evening, sir. So just revisiting your capex guidance, the first time when we had announced the capex in FY22, the business outlook looked quite stable. We used to make 16 to 18% kind of margins, even better. But now today, where we stand with the Europe slowing down, the prices of many of our commodities have eroded quite a bit, and demand is sort of struggling. So how confident are you about the expectations of your of the revenue guidance which you had given for FY27, that it will come through, because the business dynamics have changed quite a bit over the last year and a half?
So from where we are seeing, I'm sure you are also seeing the same angle. What we have said for FY27 is still standing true. And all the investment which we have planned has no change. What is changing is mostly short term, which we have been talking. Number one, nutrition business of vitamin B3 is not long term. I mean, this is the first time in last 2 decades I know this business. This kind of flu has never extended to 2 or 3 quarters. But nevertheless, it is not going to long last. This is one. Secondly, this energy cost. You see, we are taking a lot of initiative apart from getting the government coal off contract. I don't see this is longer term. This is going to be short term. We will be behind it. Beyond this, I don't see anything which is currently in problem except for the global situation of demand. Now, that global situation of demand, as we all know, India, as far as chemical is concerned, is definitely on a very high demand. So even though the global recession will happen, Indian companies of chemical will keep doing good, because there is a huge shift which is happening of demand from China to India. We have still not served the entire volume of China. We are still just in single digits of percentage which we can take from China. We have a huge opportunity. So I don't see the future as dim as you are trying to explain.
Fair enough. That helps. That really helps. That was it. Thank you so much.
Thank you. The next question is from the line of Romil Jain from Electrum PMS. Please go ahead.
Hello. So thanks for the opportunity. I just want to understand one question on fluorination. So I think we are doing some on that front. Where do we stand?
Sir, your voice is breaking up in between. If you can speak to the handset mode, please.
Yeah, can you hear me now, sir?
Yes, better.
Yes, it's better.
Yeah. I just want to understand a little bit on fluorination. So I think we are doing some capex on that. So maybe, where are we standing right now in terms of our capabilities and whether the capex has started, and when do we expect to commission, maybe some details on that. And second question is on the life sciences chemicals. Are we seeing some rebound in prices, and maybe Q3 was more of a bottom kind of a quarter there? These two questions, if you can please answer.
On fluorination, as you can see in our presentation, we have still not committed the capex. The product which we talked about is still under development and scale up. We hope that next year, sometime, next financial year, we will be bringing up that capex, and that time I will announce you. On your question on chemical intermediates, as I stated, acetic anhydride, our volumes are growing. The reason for growth is that overall demand is increasing, but there is no additional capacity which are being available globally. And also in Europe, our competitors are not in a position to produce in full volume because their cost has gone up. So I see a continued positive traction of acetic anhydride demand, and therefore, as you know, we are having the new plant coming up even next quarter. We are very positive about utilization of that plant also in future because of these reasons.
Okay. So just one question on the food grade acetic acid. So I think that was the plant that we had started. What is the utilization there? And maybe if you can just point out what kind of revenue are we generating and at what broad margins? And do we expect more capacity expansion there? Because I think that was a very positive, development that was there. So any insights on that?
On food grade acetic acid, as we have said earlier, we are under the regulatory approval process. We are going to start the commercial supplies from end of this quarter, definitely, or if not, beginning of next quarter. And we see a good traction of demand from our international customers. So actually the realization of revenue of food grade acetic acid you will see in next financial year. This year, because of several regulatory approval process as well as the FSSAI approval, etc., it took about 5 to 6 months time. I think we are going to through in next 1 or 2 months. Next financial year, you will see the revenue realization of food grade acetic acid.
Okay, sir. Thank you so much, sir. All the best.
Thank you.
Thank you. The next question is from the line of Sunil Kothari from Unique PMS. Please go ahead.
Thanks for opportunity, sir. Sir, you said this because of this road transportation we chosen for this transferring call, will it save 15-20 crore per quarter, and will it be effective from current quarter or next quarter?
No, I think you noted wrongly. Somebody asked me that from the road, if you get 100% rail transportation, we will have additional benefit of 14-15 crore. But from the earlier quarter, now when we got road transportation, there is a benefit of about 10 to 12 crore which we should accrue.
That is per quarter, right?
Per quarter.
Okay.
You are right.
Sir, and second question is, sir, we said that we got little bit ease of coal prices in current quarter. But if you take a percentage of the revenue, that has gone up from 14% to 15% cost, power and fuel cost. So why it has happened, if you can a little bit explain?
No, because all that what you are seeing softening is happening only end of the last quarter. What you will see is this quarter impact, not in Q3. Q3 from beginning it has been very high. It has just happened in the month of January beginning when, or let's say end of December, when the softening of prices have happened. So you have not seen the impact of that in the last quarter.
Okay, so both the benefit of road transportation and softening of price, both can materialize in current quarter and onwards.
But remember that any reduction in coal price imported, customers are also smart. They will ask that pass on. As we take increase in pass on, they will also ask reduction in pass on. So please don't just calculate in mathematics and add it up.
Sir, our other expense on top line of sale 3,600 crore approximate for 9 months has gone up from 336 crore to 432 crore, almost 100 crore, almost 30-35% increase. What is the reason for this other expenses I'm talking about?
So, Sunilji, first if you take on the quarters other expenses.
No, sir, I want to understand about for 9 months, because quarterly I understand there is some specific reason. If you take 9 months, it is 336 from 336.
Okay, I'll explain you for 9 months, Sunilji. So primarily the reason for increase in other expenses is A, the freight and forwarding costs has increased. And then it's partially also due to the processing charges and the warehousing charges and repair and maintenance. So these are the 4-5 reasons on account of which the overall other expenses have increased.
Yeah, but it is substantial. The same revenue, we have spent 100 crore more. That is why I'm just trying to understand. This is, we are getting on control on any cost, or it is going out of control?
No. Don't worry. Just 1 second, Prakash. Don't worry about control of cost. Very, very much control. Let me explain you. Last year 9 months, all other costs were based on the volumes which we have sold. The transportation cost, travel cost, repair and maintenance cost, everything is this year is going up because our capacity utilization is going up, our new plants are coming up. So all that is going to increase our expenses. But at the same time, you are very right. We are in full control and we have plans to improve efficiencies all over. And this is a continuous exercise. So there are some costs which this year has gone up, like travel, etc., which is usual because we are back to our normal situation of FY22.
So my last just to give you a perspective, because I think you are seeing the revenue number as the same, but our volumes have increased. It is just that prices of chemical intermediate segment has come down. That is why you see the revenue at the same level. So our volume of business has already increased. So the expenses are in relation to the volume of business. So perhaps you are just seeing the same level of revenue, therefore you are feeling the expenses are absolutely correct.
Absolutely correct. My request will be, so many people were asking about the volume growth. I think on a 64-page PowerPoint presentation, we should have every time why somebody should ask what is the volume growth quarter on quarter or year on year. I think we should follow, because every now and then I'm observing that people are asking about volume growth and we are not able to provide those exact precise number. I request, please make it a practice that we should announce, or we should announce that we are not going to talk about anything about volume. So please, follow one practice. That is my request. And sir, my last question to Rajesh ji, sir, basically what we are talking about is we will be improving our specialty chemical and nutritional business